A major financial institution just collapsed. Not from bad mortgages, not from credit defaults, not from a recession. It collapsed specifically as silver prices rocketed to record levels, exposing losses so catastrophic they wiped out the bank's entire capital base in a matter of weeks. And here's what should stop you cold. This was not just a random risk management failure. This was the mathematical conclusion of a decades-long manipulation scheme finally coming due. The institution that just fell was one of the architects of that scheme. When a bank collapses at the exact moment a commodity it shorted surges in price, you're not watching bad luck. You are watching the exposure of fraudulent market practices that created leveraged positions no institution could possibly survive. The paradox here is brutal. This bank told depositors their money was safe, passed every single regulatory stress test, held investment-grade credit ratings, and presented itself as a pillar of financial stability. But behind the scenes, it held silver short positions so massive, so over-leveraged, that a price move that should have been manageable instead became an existential threat. The losses simply exceeded the bank's capital. And now, the institution is gone. Here's what the financial media won't connect for you. Your deposits may be sitting in institutions holding identical positions, facing the exact same mathematical impossibility this collapsed bank just demonstrated. I'm going to show you a pattern so reliable, so mathematically precise, that once you see it, this collapse makes perfect sense and reveals which institutions are next. It's called the four-stage leveraged commodity short death spiral, and it has destroyed financial institutions throughout history whenever they bet against physical assets using leverage they couldn't sustain. Right now, we are watching Stage 4, forced liquidation and institutional collapse, play out in real time. The bank that just fell will not be the last. The question is whether you will understand this pattern before the contagion reaches your institution. Let me break down the mechanism, because understanding this cycle is the only way to identify which banks are on the edge of the same fate. Stage 1 is concentrated position building and price suppression. The cycle begins when a small number of financial institutions build up massive short positions in a physical commodity, creating synthetic supply through paper contracts that vastly exceeds the actual physical availability. They aren't hedging. They are making a directional bet that prices will stay suppressed, and they're using extreme leverage to amplify their returns. The concentrated nature of these positions, often just 3 to 5 institutions holding 60 to 80% of all short contracts, allows them to influence prices through coordinated selling. During this stage, the strategy looks brilliant. Prices stay low, the shorts profit, and the leverage amplifies those gains. Stage 2 is leverage expansion and physical market divergence. As the strategy proves profitable, the institutions expand their positions, adding even more leverage, selling more paper contracts against an unchanged or declining physical inventory. The ratio of paper claims to physical metal reaches extreme levels, 200 to 1, 300 to 1, sometimes even higher. But a divergence emerges. Physical buyers start paying premiums above the paper prices. Delivery delays extend. Warehouse inventories decline. The physical market is signaling a shortage, but the paper market shows abundance because of the institution's synthetic supply. The banks ignore this divergence, assuming they can maintain control. This is the critical mistake. They're confusing temporary price control with permanent market dominance. Stage 3 is the catalyst and short squeeze initiation. Something breaks the suppression. Industrial demand might surge, a geopolitical event could disrupt supply, or enough market participants demand physical delivery at the same time, exposing the fractional nature of the paper market. Prices spike. The institutions holding the concentrated short positions face margin calls. They must either post more capital or close their positions by buying the commodity. But buying just accelerates the price increase, which triggers more margin calls, which forces more buying. The short squeeze becomes self-reinforcing. During this stage, the fatal error is doubling down, adding to short positions to defend price levels, believing the spike is temporary. Stage 4 is forced liquidation and institutional destruction. This is the endgame. The price surge continues beyond the institution's ability to withstand it. Losses exceed their entire equity. Counterparties demand margin the institution cannot provide. The bank faces a choice: admit insolvency or attempt emergency measures. But emergency measures always fail, because the fundamental problem, massive losses on concentrated leveraged positions, cannot be solved by a simple liquidity injection. The institution collapses. Regulators seize control. And critically, the bank's forced liquidation of its remaining short positions accelerates the commodity's price increase, creating contagion risk for other institutions holding similar positions. The collapse isn't the end of the pattern. It's the signal that other institutions are next. Now, let me prove this pattern with two historical cases where leveraged commodity shorts destroyed major financial institutions. First, the Sumitomo copper collapse of 1996. For 10 years, a single trader at Sumitomo Corporation, Yasuo Hamanaka, built up massive positions in the copper market. He used leverage through off-balance sheet derivatives and coordinated short selling to control prices, making him a star trader. But in early 1996, the catalyst hit. Chinese industrial demand surged, and other traders began demanding physical delivery. Copper prices spiked. Hamanaka's positions moved violently against him. Instead of cutting losses, he doubled down. By June, the losses hit over $5 billion, exceeding the company's capital reserves. The institution faced potential insolvency, and Hamanaka was arrested. The forced liquidation of his positions drove copper prices even higher, creating losses for others who had followed his strategy. The first domino had fallen. The second case is even more famous: the Barings Bank collapse of 1995. A trader named Nick Leeson in Singapore built massive leveraged positions betting on the stability of Japanese markets. His positions controlled over $7 billion against Barings' total capital of just $615 million. The catalyst was the Kobe earthquake in January 1995. The markets became extremely volatile. Leeson's bets on stability turned into catastrophic losses. He doubled down, hoping markets would recover. They didn't. The losses compounded daily. By February, the losses reached $827 million, exceeding Barings' entire capital. A 233-year-old institution was destroyed in weeks and sold for just £1. Both cases show the exact same mechanics: concentrated, leveraged positions, a catalyst that creates adverse price movement, and an institution that cannot survive the forced liquidation. Now, let's look at why a major bank just collapsed as silver hit record highs. Following this exact pattern, for 2 decades, multiple banks, including the one that just collapsed, accumulated massive short positions in silver through futures and derivatives. This wasn't hedging. It was a leveraged bet on price suppression. Regulatory data showed extreme concentration, with a few banks holding the majority of shorts. From 2020 to 2024, they expanded these positions, even as physical market signals turned alarming. Physical silver premiums exploded. The U.S. Mint couldn't meet coin demand. COMEX inventories, the metal available for delivery, dropped to critically low levels. Yet the banks added to their shorts. The collapsed bank reportedly held shorts representing over 15% of annual global silver production against a capital base that could not withstand a major price move. The catalyst began in late 2024. New banking regulations, a surge in industrial demand from solar and electronics, and coordinated physical delivery demands all converged. Silver prices broke above $30, then $40, then $50 in rapid succession. The collapsed bank faced massive margin calls. Every dollar increase meant hundreds of millions in losses. And just like in the historical examples, they tried to defend the price by adding more shorts. That's when the death spiral became inevitable. The result is the collapse we are witnessing right now. The bank's losses exceeded its capital base. Regulators seized the institution, citing losses of over $4 billion from commodity derivatives. The bank is gone. Let's check the boxes. Did banks build concentrated, leveraged short positions in silver? Yes. Did leverage reach unsustainable levels? Yes. The losses prove it. Did a catalyst trigger a squeeze? Yes. Has the institution collapsed specifically from these positions? Yes. Regulators confirmed it. The pattern is complete. Stage 4 has executed. Here's what the financial media is missing. This isn't a one-off failure. This is the exposure of a systematic manipulation scheme involving multiple banks. The collapsed institution is just the first to fall because it had the largest exposure or the weakest capital. The same mathematical forces are now hammering other institutions holding similar silver shorts. They face the same impossible choice: close positions and accept catastrophic losses, or hold on and face potential insolvency. The public narrative will blame rogue trading or inadequate oversight. That's a misdirection. The real failure was regulators allowing this concentrated manipulation to go on for decades. So what does this pattern mean for the next few years? Silver's price will likely continue to rise as these massive short positions are forcibly closed through institutional collapse. Each bank that falls will accelerate the price movement, putting more pressure on the remaining shorts. We will likely see 2 to 4 more significant institutional failures or emergency interventions. The banks at highest risk are those showing similar characteristics: large commercial short positions in COMEX data, significant exposure to precious metals derivatives, and a capital base that is small relative to their derivatives book. More importantly for you, the failed bank passed its last stress test. Its credit ratings were investment grade until just weeks before it collapsed. The warning signs were not in the public disclosures. They were in understanding this 4-stage pattern. The same is true for the institutions that will fail next. This isn't about predicting an exact price target for silver. It's about recognizing that a major financial institution just collapsed for a very specific reason, proving the manipulation was real and the unwinding has begun. When Stage 4 executes, it doesn't stop with one institution. The forced liquidations create a contagion that spreads to everyone else with similar exposure. Pattern recognition beats prediction every time. And this pattern is telling you that the bank that just collapsed has exposed a systemic vulnerability. The question for you is whether your deposits sit in an institution facing the same mathematical impossibility. Position yourself accordingly, because this pattern shows that the first failure is never the last. Thanks for watching. Follow for more updates as this situation unfolds.